Okay, let's unpack this. Today we're doing a deep dive into something that, well, feels a bit mysterious sometimes, but really matters. Your credit score.
Absolutely. It's that number that pops up everywhere, doesn't it? Loans, credit cards, mortgages.
Even renting a flat or getting a phone contract. So, yeah, pretty crucial. We want to break it down simply today.
Make it less of a mystery. Fundamentally, understanding it just puts you in a much better place financially.
Right. So, starting basic, what actually is a credit score?
Well, think of it like a financial snapshot. A three-digit number, usually between 300 and 850.
And it tells lenders.
It helps them guess, essentially, how likely you are to pay back money you borrow. It's a quick risk assessment.
Like, are you a reliable bet, financially speaking?
Exactly. Are you more like a trusted friend they're lending to, or a complete stranger? That's the sort of picture it paints.
Got it. And this score, it doesn't just appear from nowhere?
No. It's calculated based on your credit history. All your past borrowing and repayment behavior, basically.
Which is all tracked in your credit report.
Precisely.
Mm-hmm.
And those reports are held by the main credit bureaus. Equifax, Experian, TransUnion.
Now, one thing people notice is you might check your score in different places and get slightly different numbers. Why does that happen?
Yeah, that's a common point of confusion. It's because there isn't just one single score. There are different scoring models.
Like FICO and Vantage Score.
Those are the big ones, yeah. They use the same data from your report, but might weigh things a bit differently in their calculations.
So, like different chefs using the same ingredients, but maybe adding a bit more spice here or there?
That's a brilliant way to put it. So seeing slight variations is totally normal.
Okay, that makes sense. So the bureaus collect the history, the models calculate the score, but what in that history actually drives the number up or down? How is it worked out?
Right, this is the really useful bit. Most models focus on 5 main things, but they aren't all weighted equally.
And some factors are much more important than others.
Definitely. In fact, the top 2 factors typically make up, well, over half the score, around 65% combined, usually.
Wow, okay. So nailing those 2 is key. What's the biggest one?
Payment history. That's the heavyweight, around 35%. It's really simple. Do you pay your bills on time?
Loans, credit cards, mortgage payments, everything.
Yep. Late payments can really knock your score down, and they can stick around on your report for up to 7 years. It shows lenders' consistency.
Right, consistency is crucial there. So what's number 2, the other big chunk?
That's amounts owed. Makes up about 30%. The main thing here, especially with credit cards, is your credit utilization.
Ah, utilization. That's the percentage of your available credit you're actually using, isn't it?
Exactly. So say you have a card with a $1,000 limit. Keeping your balance low, maybe $100, so 10% utilization, looks much better than having it maxed out or close to it, like, say, $850.
Because high utilization suggests you might be stretched thin financially.
Precisely. It signals higher risk. This amounts owed bit also looks at how much you've paid down on installment loans, like car loans or mortgages. Paying those down shows you're reducing your overall debt load.
Okay, so pay on time, keep balances low relative to limits. Those are the big 2. What makes up the rest?
Next up is the length of your credit history. That's about 15%. Basically, lenders like to see you've been managing credit responsibly for a good while.
So older, well-managed accounts are generally helpful.
Yeah, they increase the average age of your accounts, which helps build that picture of long-term reliability.
And what about having different types of credit? Does that matter?
It does, a bit. That's credit mix, around 10%. Having a mix, like maybe some credit cards and an installment loan like a car loan, can be slightly positive. It shows you can handle different kinds of financial commitments.
Okay, makes sense. And the last 10%.
That's new credit. Every time you apply for new credit, it usually triggers what's called a hard inquiry on your report.
Like a lender officially checking you out.
Exactly. Too many of those in a short space of time can slightly dip your score, as it might look like you're desperately seeking credit. These inquiries usually only impact your score for about a year or 2, though.
And crucially, checking your own score doesn't do that, right?
Correct. Checking your own score is a soft inquiry. Doesn't affect the score at all. You can check it as often as you like.
Okay, so putting it all together, what are the main action points for someone listening?
Well, it follows directly from those factors. Number 1, absolutely pay everything on time. Non-negotiable, really.
Set up reminders, direct debits, whatever it takes.
Yeah. Second, keep those credit card balances low. That utilization percentage matters a lot. Aiming for below 30% is a good general guideline. Lower, if possible.
And don't necessarily close old accounts just because you don't use them much.
Right. If they're in good standing and don't have fees, keeping them open helps your credit history length and keeps your overall available credit higher, which helps utilization.
Also, keeping an eye on your actual credit reports seems important. Checking for errors.
Definitely. You can get free copies regularly from the main bureaus.
Yeah.
Errors happen, and they could be unfairly dragging your score down, so it's worth checking.
And there's that quick tip some people explore, becoming an authorized user on someone else's card.
Yeah, if you have a trusted friend or family member with a long positive credit history and low utilization on their card, becoming an authorized user can potentially help your score. Their good history can reflect onto your report.
But obviously, you're relying on their good habits there.
Completely. Choose wisely.
Right.
It's not a magic bullet, but it leverages those core factors we talked about.
So wrapping up then, your credit score, it's not some random number assigned to you. It reflects your financial habits over time.
It really does. And understanding how it's built gives you the power to influence it positively. It's about showing you're reliable.
And a good score opens doors, right? Better interest rates, easier approvals for things you need. It's worth paying attention to.
Absolutely. So maybe think, what's one small thing you could do today, based on what we've discussed, to nudge things in the right direction?
Brilliant stuff. If you found this deep dive useful, please do give it a like, share it with someone who might benefit, and hit subscribe so you don't miss our next one.